realize that as of today, I'm eligible for that grade 55 and older plan, which is maybe
right.
But
join the club, Niels.
So let's get to questions as soon as possible. Let's start with Polo here on the right.
I can hear you. I don't think everybody else.
It's Polo Tang from UBS. Really just a question about convergence, but also cable competition. Because if you think about DT in Europe, the strategy is very much focused on convergence, and by that I mean combining fixed and mobile together. You've obviously outlined a strategy in terms of beyond the smartphone, but I'm just interested in your thoughts in terms of whether you think convergence, i.e. combining fixed and mobile, will take off as a business model in the US in the longer term. And then in terms of an add-on to that question, can you maybe talk about competition from the cable operators in terms of their entry into mobile and how you see the impact of competition from them in the longer term?
You bet. Yeah, I'll start, but anybody jump in. A couple things. One is the traditional premise around wireline and wireless is sort of falling away. You know, and 5G will only accelerate that trend. I think we're increasingly reaching a point where consumers are a little bit disinterested in our industry categories. Our industry categories are named for capital we, the industry, put in the ground years ago. The wireline industry put fiber and copper in the ground. The wireless industry put radios on towers. Customers don't care. And what's happening is the capabilities are converging rapidly and probably faster than most people realize. Neville said in his remarks that we could have never guessed when the mobile era started what would result with the digital lives we lead on our smartphones today. We really thought that 4G would be about you being able to load your cat and dog pictures faster. But it turns out that a digital economy emerged from 4G that blew everybody's minds, created the world's most valuable companies in Apple, Google, Facebook, Amazon, and others, and also unleashed innovators everywhere like Uber, Lyft, Snapchat, Instagram, and others. So this is transformational, what's about to happen. The last one was transformational, more so than we ever could have predicted. This is bigger. 5G is bigger. And the reason I say all this right now is that because of that, I think traditional thinking about these industries and how they've always been is going to fall away, and people haven't fully thought that through yet. Neville just told you his specific target, not his dream, his specific goal is a nationwide average speed through wireless of 450 megabits per second. Now, in the United States, we have a digital divide. About half of Americans, have either 0 or 1 choice when it comes to their broadband in their home. 0 or 1 when it comes to high-speed broadband capabilities. We can change that. We're going to bring meaningful, serious competition to the broadband space in 2 forms. One is, obviously, you may choose our 5G service for your home. We're going to allow that in some areas. We think we'll market that actively to probably about 1/3 of the country where we have the capacity to be able to serve that kind of volume in addition to wireless. But the other effect that's going to happen is substitution. So number one, yes, we see millions of homes getting their broadband from T-Mobile in this new combined company. But on the other hand, we see an even larger audience deciding that their only connection to the world should be their mobile connection. Today, that number is about 12%. It's quietly grown 50% in the last few years, from 8% to 12%. Ours is higher. We index much higher. Nationwide, about 12% of people rely on only their mobile technology for broadband. We think that the substitution effect is another big opportunity as customers looking for savings decide, I have to pick. Is it mobile or something fixed to the place where I live and sleep? Obviously, mobile's going to win. Mobile will win every time when you force people to change, especially once 5G changes the game. Now, the last part of your question is about they're coming into our space. Yeah, they're coming. You know, it's real. If you ask them, they'll say, look, I'm already a facilities-based wireless player. I don't know why you call me an MVNO. I've got 20 million small cells. We're like, what? Yes, I have 20 million small cells because they have Wi-Fi in everybody's homes. These guys are serious players. They really believe in the combination of home Wi-Fi and mobile technology brought through partnerships. And the results are starting to show that it's working. I'll tell you, it's not coming from us. Our numbers have been phenomenal since Comcast came out. We've had some of the best performance. We've had outperformance versus expectations. It's coming from AT&T and Verizon. But these are serious players. They're coming in, and we welcome the competition, but we don't fear it one bit. They don't have anything to offer that AT&T and Verizon haven't been offering all along, and we're kicking their ass, so it's fine.
Let me just add one quick comment, and I think it's a critical difference between European markets and the US market. Broadband is incredibly fragmented in the US. That map is chunked up into any number of slices. You've got some big players, you've got a ton of small players. As Mike said, there's half the country is incredibly poorly served. So that's a perfect environment for us to go play and disrupt. And that's what this strategy is about. Are we up here to tell you that we're going to go and demolish, Comcast in their, 20 million homes passed, whatever that number is? Around the edge, over time, sure. But that's not the major opportunity. The US market is so fragmented in cable service and broadband service. There's a map of any number of areas we can go and attack with the capability that we'll be bringing to the marketplace. So that fragmentation is key for us to go open up.
Last word on this, 0 of it are in the numbers that I showed you. Just one more time, the synergy numbers I shared with you are cost only. There's a massive revenue synergy opportunity for this combination. We're into one of the topics, millions of broadband users and the replacement value and other things. None of that broadband competition that we intend to bring is in the numbers that we showed you. It's all upside. Go ahead.
I think there was a question right here in the middle, second row.
Yes, thank you. It's Dhananjay with Bernstein. 2 questions which are related. So firstly, regarding the sustainability of your throughput speed advantage today, what percentage of your grid today, on average, in the peak busy hour is above 75% utilization? So that's the first question. The second question, and that's on a standalone basis. The second question is more related to the network synergies in your transaction with Sprint. How prepared is your grid today? Which pieces or elements are in place today for you to be able to aggressively deploy 2.5 gigahertz TDD spectrum? And what pieces are missing? So I want to just get a sense of the pace at which you're able to deploy 2.5 in a merger scenario. Yeah. 2 questions. Thank you.
Let me do the second one first, because that's the one I'm most excited about, because it will dramatically change anything we talk about in the first part of the question. What's the best way to give you a visual? If you take a market like, let's pick a big one. Let's pick New York today. We have, as T-Mobile standalone, more than 50% more sites than Sprint does in that marketplace today. And so in terms of the density and scale, now this is outside of breadth of coverage. We have a much, much larger geographic footprint when you move outside of metro and suburban areas. But come down to the core metro areas, our site density is incredibly higher, much, much higher than Sprint's. And that's back to my comment of why our network is highly suitable for that 2.5 gig spectrum deployment. Much of the challenge that Sprint has had is they don't have the site density, so they face a propagation risk and challenge. The experience is choppy. You have 2.5, you don't have 2.5, so it's the roller coaster ride that you face. That spectrum deployed on our network doesn't have the roller coaster ride in almost all geographies. We are incredibly densely built out. This is a fun story, right? Because this industry, in its early running, the folks that had low-band spectrum triumphed and won, right? Because it was about voice services. We never had any low-band spectrum. We had to build an incredibly dense network to provide the coverage with mid-band spectrum, which is all we had. Comes the era of data, and you need density. You need more sites. A mid-band spectrum network is much better suited for the world of LTE today. That's why I win on speeds against Verizon and AT&T. So we already have an incredibly dense network asset. I have almost 50% more sites than Sprint does in our network today as we start this process.
Can I just very briefly follow up? I guess the question was, what percentage of that grid are you going to need to touch physically as you deploy 2.5?
I intend to put 2.5 spectrum on 50,000 cell sites. That's more cell sites than Sprint has today.
So quick math, right? The 2 companies together, pro forma, have about 110,000 macro sites. We intend to shut down about 35,000 of those, bringing the number to 75. And then we intend to invest in about 10,000 additional macro sites to continue pushing out our coverage and density, mostly coverage. And then secondly, there's about 50,000 small cells in this plan as well on top. And all that is fully funded in the network plan and the cost to achieve that we shared with you earlier.
So does that make sense? I'm sure, I don't know if I've still answered your question. You look like you've got curiosity.
Yeah, sorry, and I hate to monopolize this, but very briefly, I guess, how many sites are you going to have to physically truck roll to deploy 2.5 versus remotely provision? I guess that was the core of the question.
50,000. Yeah, I mean, so we're going to, so the whole plan, right, is, as Mike said, there's a site count, and what we do on the anchor network is, the first thing I have to do is deploy that 2.5 radio in T-Mobile land. And at the same time, the keep sites from Sprint, there's about 11,000 of those, we deploy our assets. So our mid-band spectrum, some of our low band, some of the millimeter wave, that will go on to the Sprint keep sites. And so you bring the whole portfolio up to that capability across all bands. Not everywhere. There's a transition point at which 2.5 doesn't make sense when you move into outside of metro. Just your quick question, so on 75% utilization. So our performance with speed today, our congestion is, we don't even think about it right now, it's the lowest level it's been in the history of the company. And that's a combination of everything we've done with LTE Advanced. On a standalone basis, we have an incredibly strong growth path with license-assisted access. What we're doing with small cells, we have a whole plan. So there's very little of the network is stressed at that 75% rate that you mentioned. It's less than 1% of the sites during a busy hour.
Okay, let's go to the first row first.
Power. Nils gets to decide whose question. That's power.
I thought Nils was going to answer some questions.
Thank you. Thank you very much, Jack Abramovich. So just to make it clear, if you move the 50,000 cells to 2.5, there's no risk in the short term of your network speeds dropping because of the lower capacity of Sprint. So that in the future tests that you might actually end up worse because Sprint has the lowest speed network and you have the highest speed network, that in the short term there's no risk of that.
No, and that's the whole anchor strategy, right? So the performance of the T-Mobile standalone network, that's going to continue to grow and improve, okay, right, as we drive features and capabilities. On comes 2.5 gigahertz spectrum. Great thing is that, you know, a lot of these phones are already, our phones are already banded for 2.5. They need to carry a bundle from Apple and so on. As I said, there's a lot of Sprint phones that can come straight across the banded for AWS, even though Sprint doesn't have any. And so we're in this position where we can leverage both handset bases in a majority fashion on the two separate sets of assets as we combine them on the one network.
And there's fallow spectrum to allow this refarming, and that's something the competitors don't have. It's something that makes this combination an incredible moment in time. When you put these two together, you have the fallow spectrum to do this migration, and you do it city by city. So you go into a city and you put them together, get the T-Mobile, you know, anchor network ready, and when it's ready and it's got the right assets, then you migrate the customers in that city. And what happens is that the next day, that Sprint customer just wakes up and has a better experience. And we lived through this with Metro PCS. That's right. A lot of people asked us when we did Metro, they said, okay, you have 8.9 million Metro customers. How many of them can you hang on to through this type of migration experience when you're literally turning off their CDMA network and forcing them onto Sprint or onto T-Mobile? How many are you going to hold on to? 8.9 million. Well, we held on to virtually all of them and doubled. Doubled, right? So we think in that whole equation there were about 50,000 customers that opted out through the journey. And in the meantime, we doubled the Metro PCS business because the vast majority of people woke up in that city. They had a measurably, strictly superior experience, and they were happy about it.
That puts me to my next question, which is Metro PCS. Since the merger, you've actually increased the retail distribution from 4,500 to 11,100. You're keeping the brand up. You're actually promoting it much more. Sprint you want to make to disappear into AT&T. When will Metro PCS disappear or also be merged into T-Mobile US?
Well, it's interesting. You know, this combination, we have the potential of an incredible brand portfolio. T-Mobile, Sprint, Metro PCS, Boost, and Virgin. And we haven't announced what our brand portfolio strategy is yet. I think it's really important that we get through this competitive deal pendency period. It's obvious that we see big synergies on the postpaid side. And so if you look at these numbers, obviously it looks like it's going to be majority one postpaid brand. But we just don't want to get into details on brand strategy right now. There's a lot of optionality. We need to study it. And we also need to make sure that on both sides during the pendency of this deal, number one, we compete hard. And number two, we keep these dealer distribution networks going. So we're going to wait and talk about brand strategy after the close.
And if I could just add on that, so from a network perspective, the network transition is almost, it's brand agnostic, is the way I talk about it. So if you think what we did with Metro PCS, big part of the success, as those Metro PCS customers migrated, their experience stayed the same. We didn't touch their billing, we didn't touch their voicemail, their specific services. We just plugged all of that into the T-Mobile network and not the Metro PCS network. Now again, I make those things look really simple with my hands. That's a lot of work. But what you do is you create a position where the business has complete flexibility on the brands it selects to operate on a go-forward basis and the time at which it might decide to change those out. So for example, on Metro today, that still runs on Metro billing. It's a small adjunct, nice tight business unit. There's been no reason to disrupt that. But the network experience changed almost day one for a large number of the customers.
Okay, let's go to Emmett in the last row there.
Yes, thank you very much. It's Emmett from Morgan Stanley. Just one question, please, on the merger and the outlook that you see for potential job creation. And if you can maybe say a few words on how many jobs might be created through onshoring of call centers, maybe the 5G network rollout, the increase in the retail network as well, please. Thank you.
Yeah, I'm glad you asked that. A lot of people have said, hang on, isn't this kind of soundbitey? Like, okay, so you're saying you're going to get $43 billion in cost synergy, and you're also saying the combined company is going to employ more people from day one and every year thereafter, forever and ever, amen. How could that possibly be? And let me just kind of unpack it for you a couple of ways. Number one, we do see big opportunity to bring these companies together, and we have $15 billion in cost to achieve in that equation. So obviously in the early years, there's a need for us to invest that money in teams to make all this happen. There's a few categories. Number one, $40 billion in capital over the next 3 years is going to get spent after the close to make this incredible network experience that we just showed you. That means engineering jobs, that means construction jobs. There's just a lot of impact there. Second, we think this network has for the first time ever, a serious ability to take on AT&T and Verizon in the enterprise space. We funded a big expansion of our T-Mobile for Business group in that era. Thirdly, you mentioned it, customer care. We expect to roll the T-Mobile model for customer care across the combined customer base. This isn't about some deliberate political pandering onshoring. This is just as simple as the T-Mobile way of doing business is something we're incredibly proud of in customer care. Witness all-time highs in customer satisfaction, all-time lows in cost to care. So we're going to roll that across. Our model tends to be more onshore. It's about 55% onshore with our team of experts concept. Theirs is about 10% onshore. So there's thousands of jobs there. And then finally, in retail, we're going to be expanding our footprint. I talked to you about we're in 265 million pops with retail right now. We're going to all the pops with retail in this business. So there's hundreds, maybe even 1,000 new stores in this model or more. That's more people. Now there's also net consolidation of stores, which will result in displacement of some jobs, but not as many as some people think, because it turns out that the amount of people you need in retail is much more a function of the size of your customer base and your share of gross ads, not the number of doors. So we'll have fewer doors with more people per door to be able to handle the opportunity in front of us. So how does this not all get in the way of synergies? That's the final piece. And the truth is, obviously, we have funded synergies in the first 3 years, but in the out years, we see $6 billion, maybe $7 billion in pure cost synergy on an ongoing basis. And most of those are not in the job-affecting areas. Most of that has to do with avoided capital in the network, and it has to do with avoided leases in the network. That's the majority of it, neither of which really directly affects jobs. Secondly, by that point, again, 4 years out, we will be a much larger company having invested with that fully funded cost to achieve in new business models that need teams, like a broadband team, like video team, expansion of our opportunity. So by the time we're there, we're a $100 billion company with an organic need for a bigger team that doesn't get in the way of synergies. And we've kind of laid this out in great detail year by year. And the result is massive cost synergies while over time having more domestic, maybe not more total, but more domestic employees in this company at close and for every year thereafter than the standalone companies, mostly driven by growth.
I think there was another question in the first row here.
A couple of questions. The first one is for Neville. Most of your comments relate to the radio segment side of the network, so spectrum, base stations. Yesterday we heard from the CEO of Deutsche in Germany how important is backhauling. So my question is that how is backhauling for you guys in the US? And first of all for you, and how you compare vis-a-vis the like of Verizon and AT&T on that particular extent. Okay. And the second one is on, you talk extensively about the merger, and all your targets are with Sprint. That tells you how confident you are that the deal will go through. If you can share us with also what will happen, your plan B, in case the merger will not go through, and all this capital, because most of the synergies, as you said, is of course the lease that you will decommission, but also the fact that you don't have to spend significantly to achieve the depth that the spectrum of Sprint will provide to you. So if you can share with us how the capital intensity of standalone T-Mobile will look like without Sprint, and to that extent, as the third follow-up is, would it be a bit disingenuous to announce a share buyback so significant when potentially, if the deal doesn't go through, probably you need significant capital to invest and to take or to keep the lead on your network? Thanks.
Take the first.
Okay, yeah. So the backhaul situation. So this is going to sound somewhat arrogant, but we were the first company in the US to drive fiber to the cell. It wasn't Verizon and AT&T. It was T-Mobile US. And so 7 years ago, we embarked on that program, and we leased lit fiber effectively to our cell sites. That's what we've done, and we've done for a number of years, and we reach 99% of our sites with that. There's a very small handful of sites that are microwave. We've even got some satellite stuff, but it's de minimis handful of sites. So we're a lit, leased fiber backhaul shop today because we don't have, and we've never had, the fixed assets to leverage. So here we are as we move into a 5G era. So why did we go in the first place? We went to fiber in the first place because of our vision of what would happen in the 4G space, and we were right. You couldn't scale copper, which was kind of the old model that AT&T and Verizon were still running on. 7, 8 years ago, we had 3 or 4 T1s in the US, E1 equivalents here in Europe. So 5 megabit maybe capability on a cell site. Today, I mean, on fiber, we're running 100, 200 MIP, 300, sometimes half a gig circuits for fiber. What we're in the middle of right now is recontracting that entire base of sites and the fiber deals for multi-gigabit service. And so today we're securing gigabit service prices of what we were paying 3 T1s for if I went back 7 years ago. We're not just contracting for gigabit service, we're contracting for up to 10 gigabit service on our sites, and some in cases. And the fun thing is that in the US marketplace, there's incredible competition in that broadband marketplace. And we leverage everybody from utility companies, cable companies. Verizon and AT&T have actually stepped up their game commercially very aggressively over the last 3, 4 years. And so we have a very strong backhaul model on lit. We are doing some dark, but every financial number we put in front of yourselves and everybody in the community is our leased fiber model taking us through 5G that we're contracting and building towards today. Now, is there a point in time at migration, maybe in the next decade, where we would go to more more dark services? Potentially, especially in some of the density in a New York or a Chicago. But we're only doing that very lightly today. So that's the backhaul story for us.
Yeah, and on the capital and the standalone story, hopefully you got from my remarks, we're really excited about both of these futures. On the capital front, on standalone, we don't see a big catalyst for a change in the capital profile of the business in the medium term. So we intend to continue investing to densify, add capacity to our network, to continue rolling out 600 until it touches every relevant part of the market and leverage that investment we made. Both the standalone and the combined business plan have placeholders for smaller than historical, but some investments in higher frequency spectrum as well. We're going to be investing in small cells to roll out across the country, including in unlicensed, which is a big opportunity for us. So we're going to continue to invest generally speaking, in line with our historical norms, which means there's some capital efficiency to expect on a % of revenue basis going forward. The difference in the two plans is around the size of our aspirations, around unleashing both a bigger growth trajectory story than we can afford to do standalone and a bigger value creation from that growth because of the efficiencies of the network that Neville just reminded us of. That's a massive upside for our business when we can get it done, and we do expect to get it done. But standalone, you know, nothing has changed about our story. This is a company with great standalone prospects, and the thing about it is, if you just play forward the growth that we've been able to create, all that upside in growth that I just shared with you from the chart, and then the capital efficiency picture that we just talked about, the cash generation potential of this standalone business is also exciting. Now, we've only guided you through 19. We haven't provided you with long-term guidance. There was an aspiration that DT shared that suggests a longer-term picture that I think in no way captures the size of the potential. We're pretty conservative around here. Hopefully you've seen that. In a company that over 5 years has never missed a guidance number, not even by a little bit, obviously we're a little bit conservative. If you just fast forward that revenue picture, the EBITDA efficiencies I shared with you from our digitalization strategies, the upside in growth, and then the capital efficiency I talked about of keeping capital numbers roughly in line nominally, not as a % of revenues, there's a massive cash generation opportunity here in 20 and beyond that we're very excited about. So hopefully that answers it. And no, it's not, by the way, you asked, the share buyback program, not only is it not disingenuous to share that now, but we thought it was very important to share it because it's a great mechanism for you to understand our board's confidence in the cash generation picture. That we can say, yes, on a standalone basis, we see at least another $7.5 billion in buybacks so that you understand that we're confident in the long-term cash generation picture of standalone T-Mobile.
Unfortunately, I think we're done. Otherwise, Hannes will get really mad at me, so we need to stop now.
You guys, thanks so much for the opportunity to be with you this morning. We really appreciate it.
Sorry, das hätten wir so lange weitermachen.